I don't want to set the Link Marines on you because I know that
we're very good friends, the Link Marines, and I love that. I love that idea, and that's our mission. That's why we're working super hard to try and bring every single asset class we possibly can on chain.
Do you see it eventually transition into becoming a standalone layer one itself?
That's a good question.
GM, afternoon or evening, and welcome to another interview here on Coin Bureau. And today I've got Mike Cahill. He is the CEO of douro Labs, which is, of course, the developers behind the Pyth Network, a high-performance Oracle network for blockchain. So, Michael, welcome to the Coin Bureau.
Nick, thanks so much for having me on. Excited to be here.
Pleasure having you here. So we obviously got a lot of questions to get through, and I want to dive right into them. But I think it's important first to start off with a bit of background, not just in terms of what is Pyth Network, but also in terms of your background. So if you can just start off with basically, what is your background, Mike? How did you get into cryptocurrency? And would you then explain in simple terms what Pyth Network is and what you're trying to achieve?
My background is in traditional finance, then high frequency trading, and then crypto kind of deal making and building and high frequency trading. And so the way that started was at Morgan Stanley in right at the heart of the financial crisis. Electronification was like a big deal. I was on the FX desk, and I realized that that was going to be the big trend. And so I decided to try and get myself as close as I possibly could to the algorithmic trading. So I left Morgan Stanley, went to a company called KCG. It's now owned by Virtu. It's one of the large high frequency trading shops. The idea was build out an FX desk there that looked like Morgan Stanley. We were pretty successful at doing so, but eventually got bought by Virtu. Now, I don't know how much you know about the mergers of two like public companies, but when you're and both KCG and Virtu were public companies, but when you're under a potential acquisition, you definitely don't want to do any work because you may not work at the new joint companies. So I was during 2017, I was basically waiting out this merger, and it was like the first epic bull run with all the ICOs. And I was surrounded by some incredible traders who were super hungry to do something, and got really deep into the ICO market, reading white papers, figuring out how to operate. And I just got totally red pilled, and got really into crypto. From there, I ended up taking like a standard job at like an exchange. I wanted to see how exchanges worked and kind of get that vantage point. I worked at Cboe Global Markets, and I never stopped thinking about crypto. And the opportunity came up to work with some of the people that I'd worked with previously, but over at Jump. And I joined in 2019 to about a 25-person Jump crypto trading division within Jump, that was led by the founder, and that was wild. That was such a whirlwind to be able to be at the epicenter of trading. So Jump at the time was the largest trader, but it was still super early days. My thesis going in was I'm going to be able to meet Steve Jobs when he's in his garage still, and it was certainly the case. I got to meet like now the most amazing people, like the Tollies and Rajes, Goon from Avalanche. And it was they hadn't necessarily made it yet. Like their tokens weren't even out, and even when they came out, they weren't even huge. So that thesis turned out to be correct, and I was super honored to be there. And we started contributing to a lot of projects, and this is really where the Pyth Network came from. We saw a huge gap in like the core infrastructure and of DeFi. And we thought that this gap was going to be one of the linchpins, or one of the reasons why the network, like the whole DeFi space, couldn't grow. We talked to a bunch of projects to try and see if they could solve it, and nobody was figuring it out. The biggest misunderstanding is that all the world's data is kind of free, because that's how we think about data today, right? Like it's like everything you really want to know is mostly on Google. You ask Google or you ask ChatGPT, with one exception. If you work in the financial industry, you know that there's a huge carve out for it. Bloomberg won the financial market data business. Google did not, right? If you go to any of the trading desks around the world, no one's using Yahoo Finance, Google, or TradingView. They're all using Bloomberg. And the reason for it is because that data is so closely held. And so when you take a generic solution like the Oracles at the time, and those generic solutions are, we're going to go get data from wherever it is, and you say, well, how are you going to deal with this huge problem where there's billions of dollars worth of data and they have no interest in bringing this to DeFi? There was no good solutions. And so that was the intention around the Pyth Network. We want to solve for the speed of data, but we also want to be able to be comprehensive in the entire suite of things that people are going to want in DeFi in the future. Right now, it's just crypto. Crypto is an easy problem, but we want to be able to provide equity data from everything around the world, futures, et cetera. And that's really the genesis of the network.
It's very fascinating. I mean, it's obviously like the need at that particular point in time. So about 2019, 20. You say it's when you actually start working on Pyth or get the idea, the inspiration to actually develop a new Oracle network?
It was the end of 2020. So let me just repaint the picture of what 2020 looked like. So we had the first wave of DeFi. I call it DeFi 1.0. Compound kind of kicked it off. It was like in the summer where the token was launched, and then they had like the first farming program, and
Food farmers.
And people got very the yield farming, because then it was like we're going to get users, we're going to incentivize users to do the thing that we're going to eventually do. And that was great. Like, you started seeing everyone looping, and that's why farming was like kind of going back and forth. And we saw lots of copycats, but the build space was so limited by EVM or by Ethereum at that time, right? So your 12-second blocks, like 12 transactions per second. The best you can do in the world is like lending protocol, and then if you want to trade, it was AMMs, and AMMs were great for dealing with those constraints, but they're certainly not the best way to trade. Like, and we've seen obviously evolutions of the AMMs, version 1, 2, 3, 4. But that was it, right? We were seeing it was almost like a throwback, right? It was like the 64-bit version of a video game. And it was fun because we were trying things new, and like the trust was like the novelty of it. And so people that really valued trust were in the network back then, right? Like on blockchains. And that's where, we started to see the emergence of kind of DeFi 2.0. So DeFi 2.0, I would say, was kind of hallmarked by Solana. And in particular, we started to see for the very first time stuff like on-chain order books. So that was Serum, now OpenBook. And like on-chain perpetual markets like Zeta and Mango back then. That is when things started to get really interesting. We had a couple thousand transactions per second were available. You had 400 millisecond blocks, and it's starting to look a little bit more like the off-chain world. And I think the question was, how and who is going to list equities on a DeFi exchange? Because there's all kinds of limitations from the big trading firms on what they're going to be able to trade based on like certain licenses they had. And so our conclusion was, it's probably not going to be any of the big traders. Instead, what you probably want to have is just a really accurate price, and then go have the markets be bootstrapped some way, using like the mechanics of, or the incentives of like a blockchain. Like, if you think about how they kind of outsource like the LP pool, like you can come up with a way to create a market where you just have a really accurate Oracle price, could be any market in the world, and then have it be bootstrapped by a decentralized LP or a centralized LP. And that was our thesis. And we still believe that thesis. I still certainly believe that thesis is going to be the way that we're going to onboard the whole world to a global financial ecosystem. And I think you don't actually need these things like tokenization the way that people expect. I think you can do this in a much faster, more efficient way. Certainly tokenization will happen, but I think it'll be kind of one of those fast follows. I think you can do this in a way that looks a little bit more like the growth of Uber. And I think there's a lot of similarities. Bear with me. I think there's a lot of similarities with how Uber grew and how DeFi has been growing. So if you remember, Uber was like in 2007, when they came out, they were objectively the best way to hail a taxi. But there was all kinds of problems with taxi regulations. Like in the US, each state had their own regulation. It looked exactly the same as the next state, but they were incompatible with one another. And Uber is just like, we're not a taxi company. We're a technology company. We're just going to go and grow, with whatever like limited scope we can, but like wherever we can. And if you try and shut us down, we'll go somewhere else. And over time, they were very successful in that, despite the fact that, when you first had Uber, it was like you had to go and pretend that your father was picking you up at the airport. And they're like, there's no taxi rides here. Don't take one of these. But they persevered, right? Because it was objectively much better. And then eventually they got big enough to the point where they could make deals with the local taxi regulators. And now if you go land in an airport in New York City, there's like, probably everywhere around the world, here's how you go to, a ride hailing app. And they don't have like third class citizenship. They have, at least second or maybe first class. So I believe the same thing will happen with crypto. Is you have all the building blocks there. You've seen a huge amount of demand and appetite to trade on DeFi, which has grown year over year. And all we need to do is kind of bolt in additional symbols. And you can get into you can imagine a world where places that have never had access to investable assets in the past, which usually have a much higher percentage of ownership in crypto assets. So the places like Nigeria or Brazil, South Africa is another place. If you look at the distribution of like the shareholders of Microsoft shares versus the shareholder or the percentage of ownership of Bitcoin, the emerging world is completely left out. Right? They can invest in Bitcoin because it sits outside of whatever regulations is trying to keep that money inside that country. And I think that those parallels are so important because it's objectively a better way for them to get access to capital markets. As soon as they can get into Bitcoin, they can now get into other investable assets. It's arguably the best way for them to preserve or grow their growth and take care of their own finances. And so that's ultimately the vision that I'm most excited about. When I think about like growing Pyth, it's how do you get the price of everything all around the world so that everyone in every jurisdiction has this leapfrog style technology, just like Uber was a leapfrog style technology for people that never really hailed taxis before. They didn't call up taxi companies, but now it's in your phone. Like the same with like having the whole world's supply of music in your phone. I love that. I love that idea. And that's our mission. That's why we're working super hard to try and bring every single asset class we possibly can on chain.
Yeah, it's a very good point, especially the relation to Uber, because obviously they move very quick to build out the technology and then obviously faced off against the regulators. And we're going to get to it a bit later with regards to obviously crypto regulations. It looks like it's blossoming and, things could be changing, which could obviously bring forward this vision you have for decentralized assets that anyone can invest in, relying on price feeds, highly performant price feeds at that. So I'm just curious now in terms of growth. Obviously, Pyth is a multi-chain, right? You've obviously initially natively on Solana, and you've expanded out, and you've now expanded to numerous different blockchains as well as many different data providers. So I'm curious, where are you seeing the most growth in terms of networks right now in ecosystems, and demand for your Pyth data feeds?
Yeah. So to give like the listeners a clear picture of where Pyth excels is in this DeFi 2.0 area. So Pyth is by far the largest oracle when it comes to the total transaction volume enabled. So all the major perpetual markets on the major chains, they use Pyth as the oracle to enable this to happen. There's about 50 to 100 billion dollars in transactions, in volume transactions that occur each month based on the Pyth price feeds. And DeFi 2.0 is what we think is going to be kind of this killer use case, or others that are kind of derivatives of that. And so our usage tends to correspond. So right now, where's the majority of the trading happening in the world? On Solana, and that's where the Pyth price is used the most. But there are other areas where there are fast blockchains like Blast and Base and Arbitrum, where Pyth has very high utilization as well. To paint you a picture, I know that you've gone over this before, so I'm not going to belabor this, but Pyth operates a blockchain called the Pythnet. All the prices are there, and we've since deprecated the Solana push one, and so that's all moved over to be poll-based as well. So all blockchains, and there's about 100 of them that are connected to the Pyth network, have the same equitable access, the same symbols everywhere, the same update times and refresh times, and the same delivery mechanism. So it's a very fair and equitable market. And we tend to add about 5 to 10 chains to the network per month. There tend to be about 20 new applications that integrate Pyth every single month as well. And then this volume growth is the one that like we really count as sort of our holy grail metric. So the areas where we think we've got the most potential to grow are going to be those fast blockchains, where there tends to be excitement or growth around trading a new perpetual market. But like over the last, I'd say, month in particular, Pyth's dominance on Solana growth has been high. Actually, one more point that I should make. So there's about 40 blockchains that they have what I would classify as DeFi 2.0 style trading. And if you were to do a percentage of value or volume that's secured on those blockchains, Pyth secures over 80% on 75% of them. So of the 30 out of 40, Pyth has over 75, over 80% of the total volume secured. So the market share of Pyth on chains where it's prevalent and where it's active is huge. So a lot of people mistakenly think of Pyth as being like just a Solana Oracle. Pyth started at Solana and uses the Solana technology for Pythnet, but Pyth is by far the most dominant Oracle on Sui or Optos, or Injective or Blast. And it's the case that any of these chains where there's applications that are high throughput or fast or need this type of speed and reliability or access to other asset classes beyond crypto, that's where Pyth really excels.
Okay. So I want to come back to 2 points you raised there then in terms of specifically as relates to comparisons, other chains as well. But you obviously focus there on the total transaction volume metric, right? Whereas obviously some people may look at the total value secured. So, how do you interpret this contrast, and why do you think focusing on the total transaction volume is more representative of the value of an Oracle protocol as opposed to total value secured?
Yeah, so I would say that total value secured is more of a DeFi 1.0 metric heuristic, and it relates back to you didn't have much expressivity on the first version of Ethereum, and so you could easily lock a whole lot of value on something without having to do very many transactions, and Aave and Compound have done that, and Aave in particular has largely maintained their share as the market leader. And so, I think about this as DeFi 2.0, and I think that's sort of the direction. Specifically as it relates to oracles, it's also a much better model and heuristic on what is going to drive value in the future. So an on-demand oracle monetizes every time one of the transactions is pulled onto one of the chains, right? So this Poll Oracle network has a fee mechanism where if on any of the 100 blockchains that Pyth data is available, every time a transaction comes across that blockchain, they pay currently a placeholder, but a small fee. And there are about 4.5 or 5 million transactions every single day that go out to different blockchains and are fed into applications for them to use for their users. That model makes a lot of sense to me. That scales up really well. You pay for what you use. Those fees can become material. The DAO has decided not to make those fees meaningful yet, which I think is the right move because, we think about the monthly active users on DeFi, the numbers are still small when compared to like the entire internet. And so it's trying to monetize like Facebook way too early, in my opinion. I think you want to keep those fees as low as you possibly can and see things like the fees become more competitive for gas. I think that the whole network of DeFi could be faster and cheaper in general before we start getting into the optimization on kind of user fees. And so I think that's sort of the right heuristic. When it comes to like the total value secured as a monetization strategy for an oracle, I don't see it making a lot of sense because if you were to try and monetize that, it looks a lot more like an AUM or assets under management style fee. And I don't see the appetite for people to want to pay an oracle for, let's say, assume that Aave's got $30 billion. How much would they be willing to pay to have their oracle secure that, or their users pay? That model to me has a direct corollary within the traditional markets. Real-time market data is used in trading and it's worth about $8 billion, right? So this is the high frequency DeFi 2.0 data that Pyth is really focused on. It's about $8 billion. There's another type of financial market data that's also valuable and it's not high frequency. This is the licensed data. So like the S&P 500, whenever you trade an ETF that says the S&P 500 on it, the S&P gets paid something for it, right? And it's a licensing thing. You built up this great brand reputation and you get paid in arrears based on the activity that you have. It's not high speed or anything. I think that's the heuristic for total value secured, but I don't think it's on a single asset basis. I think this happens more with indices like the S&P 500. So I think as that market evolves, you'll start to see, okay, what's the assets under management for a particular indice that's run by a data or oracle company, and what's the potential for yield there. For the areas where we're still focused on in DeFi right now, it's really the transaction volumes I think that are the most important.
Yeah, also because TVL can sometimes be a fleeting metric in DeFi protocols as well, right?
Absolutely.
Which is what you secure in. And then coming back to another technical point you mentioned there, of course, I believe it's the nature of the pull versus the push-based approach for data feeds. And I'm curious if obviously you utilize the pull-based method as opposed to many traditional oracles rely on the push-based. So what do you see are the key advantages of the pull method?
It's really around the efficiency, and um, the reason for it was when Pyth first launched. It launched on Solana mainnet, and it was heavily used, but it also used up a tremendous amount of the block space. I think at the all-time highs, Pyth was like 75% of the Solana block space. And that only works if Solana were to be able to scale their block space exponentially, and it hasn't yet been the case. So if the desire for Pyth is to be really the price for every asset, then you need to be able to have that capacity, be able to support hundreds of thousands, if not millions of symbols. And you can't really do that on a public blockchain. Certainly not at the scales that we're anticipating over the next couple of years. And so it really makes sense to do this on a singular blockchain. Doing it off chain is probably cheaper and more efficient, but then you lose out on all of those mechanisms that preserve trust, right? Like, so oracles at the most core are these trust machines. Like, how do I trust you? And the way that Pyth does this is, first we tell you there's 120 publishers, and here are all their names, and they're all firms that have got another business to run other than providing data, and they're proprietary owners in all of their data. But rather than us just telling you, we also have this public, auditable blockchain where you can go and evaluate how many publishers are live in a particular symbol. You can see all the contributions at any given point. If something were to look fishy, then you would go and investigate that. And I think that transparency is super important. It was one of the reasons why all these kind of competing trading firms agreed to participate in the network. They don't trust any of their competitors. But the fact that it was a public blockchain meant that no one owned, right? Like the network was running, meant that you would be able to get the largest traders, and certainly the largest in each of the asset classes that they're specialists in. So Susquehanna, for options, and Jane Street for ETFs, and Jump for futures, Virtu for equities, to be able to get them to contribute to this singular solution to solve this market data problem on chain required this. If this were to be done in a data center, there's no chance in a million years that they would ever participate, because they would assume that one of their competitors had a small edge over the other one, and they wouldn't do it. So I think it's paramount to be able to create this. And the reason why it works is, as I described, that as you need data, you pay for it. And so that example of just kind of spamming Solana and being 75 blockchains, that was the fastest or the highest throughput chain. If you've got a 12-second transaction per second count with high gas, like the design space just doesn't work at all. And so this model is really great, where it's the Pythnet can just continuously get bigger and bigger. And I hope we'll be able to talk about some of the plans that we have for it to grow. But like, let's imagine a world where it has now hundreds of thousands of symbols, and like the update times are a little bit lower. That's now available to everyone, right? You're not limited where it's okay on Ethereum, we're going to update once a day. That's terrible. That's if you're only updating based on what we decide the metrics are, like 50 basis points, it's a horrible use case for anybody on Ethereum. You should be able to have at the app level the ability to say, all right, I'm going to choose when I want to pull that price, but I see them all. And my users get to see them all. And then when they want a price, they pull it in. And maybe it's during high congestion and the gas is expensive, but maybe that's really valuable to have on chain at that time. So model works really well. It's super elegant in the fact that it has all the trust properties of a public blockchain, and it has all the efficiencies of effectively running off chain.
So obviously, Pythnet. My first question is, do you see it eventually transitioning to becoming a standalone layer one itself?
That's a good question. So I'm gonna take a slightly longer way to answer that. Okay. So because it sort of depends.
Yeah.
Global financial markets are our goal, right? Like our goal is so that someone in rural India has access to buy Tesla or Pyth or whatever it is at any given point, right? Like that kind of leapfrog technology. Now, if you just first principles, like what is finance? There are three components to an exchange. There's a price, execution, and clearing, right? And now everybody knows that a blockchain is the best for clearing.
Mm.
And most people realize that DEXs are the best for exchange, and understand, that the price is sort of like, if you just focus on the price, that's going to be really important. This happens, by the way, in all of the financial markets that are off chain. I'll give you one example of the US equity market. So in the US, there are 27 approved exchanges. Most people know about the New York Stock Exchange and NASDAQ, but there's 27, and obviously there's a power law distribution in the volume of them. But the price that people trade at, so if you're trading on like Charles Schwab app or Robinhood, you're actually not getting price from those exchanges. You're getting a price from something called the NBBO, National Best Bid Best Offer, and it's constructed by a thing called the SIP. It's this like kind of aggregated price. So what it does is it combines all the best prices from all these 27 exchanges, creates price, that here's your national best bid, best offer, and you get to execute on that. So when you're trading on Robinhood, you're guaranteed to get this national best bid, best offer. Behind the scenes, there's something called payment for order flow. So Robinhood themselves actually get a little price improvement on it, and that's how the business works, and you don't have to pay fees. It actually works pretty well. And then there's a clearinghouse called the DTCC, and that settles all the trades. And these are all ring fenced. You can pick another example within kind of any other jurisdiction. So the analogy is perfect, right? Like on chain, you need a price, you need execution, and you need a blockchain. So I think that there are three ways with which this grows, right? There's the first one is like the fat protocol thesis. And this is like the Fred Wilson idea from long ago, that the protocols are going to become like the internet, and then all the applications will have to have some gas fee that are paid to the protocols, but they'll never be as big as the layer one or the protocol. And therefore there's this like value sinks down to like the layer one. That works if there's like one blockchain to rule them all. And I think that, it's pretty clear now that that won't be the case, either because of preferences for Solana versus Ethereum, Rust first, Solidity, or whatever it is. Or it could be like, that a country's jurisdiction comes in and they cut a deal like, Uber's regulators did. And they said, we're going to have a permissioned version of this running in our country right now. There's a lot of reasons why, like, it's not going to be one necessarily to rule them all. The second one is that, by the way, if there was, then the value would all accrue to kind of the blockchain, but there would be this federated state of lots of different exchanges on that blockchain, or could be. And then the price is very important as well, because all those different exchanges now need to contribute and basically trade at this aggregated price. In that model, I think it's great to just be the price, just focus on that singular price, and there's going to be a tremendous amount of value for everyone, right? These operate in different silos. Scenario number two is that everything converges to a singular exchange. So let's imagine that there's like one Binance or NASDAQ that does everything. They become the trading house for everything. That's probably, in my opinion, the scariest example, because they don't need their own, they don't need a public blockchain. They have their own blockchain. You go there, it becomes the everything store. The likelihood that they then act monopolistic in the future is much higher. You actually don't really need a price layer at that point. If you're the only exchange, then you are the price.
Yeah.
It's like the Captain meme. I am the price now. So that's like, the one that scares me the most. And then there's like version 3, where it's like a lot of different options. And this version, I think the price becomes the most important, because in all of those options, they're all repeating their price updates to the network, to the Pyth network. And they're basically competing on the fact that you want the Pyth price plus 10 basis points. It becomes really fair all around the world. Doesn't matter which blockchain you're settling on, as long as Pyth is connected to them and the applications can grab that, then the Nigeria version of whatever like global exchange you have there that's approved by the local regulators, because Uber does have local offices. As long as you're getting access to the Pyth price, you have access to the global markets, and it's a fair price. And you'll know what your fee is because they have to articulate it to you. That to me is the most bullish case. So I want to grow for that. That's what I really want to grow for. In order to get there, being just the price layer for like hundreds of thousands or millions of symbols is really important for us to do. If it turns out that that's not the case, the way things grow, I would be much more in a position to try and get into the execution as well as on the settlement side of things in ways with which, like, similar to how traditional finance has grown. Like, people have co-located next to the exchange and things like that. I think that's probably a worse outcome for the whole world. I think the best outcome is you have independent operators for each of these things. And that's the one I'm most optimistic for. But and there's, by the way, if you're just the price layer in the whole world's exchange, like that's a pretty valuable role to do. There's no reason why Pyth needs to also be doing some of these other things.
But then this just comes back to obviously, and obviously, it relates to the use cases for the Pyth token, right? Now, obviously, it's used for staking, and I'm curious in terms of plans. And I know there was proposals earlier this year in terms of governance votes, but in terms of more use cases within the Pyth, network itself, specifically potentially as relates to paying for fees. Now, I know that you've mentioned that fees are set in the native token. One way, right? The minimum fee that's been paid by the native tokens can be paid, but it's paid in the native token of the network, or the blockchain, which is pulling the feed, right? So
yeah,
I'm just curious in terms of like, obviously, token talk can sometimes be a bit fraught, but I'm just curious in terms of like broader use cases from a utility perspective for Pyth token itself within the ecosystem. I'm curious if you've got plans for them.
Yeah. So I'd say like the 60,000 foot view is like, at maturity, the Pyth token should be used to pay for the Pyth network data. Okay. and so how do we get there, and when do we get there? It's not entirely clear. The first thing is you need to be paying for the data, and as you mentioned, like these are placeholders, and I think that's actually the right model. So long as the market continues to prioritize growth over revenue, which again I think is certainly the right thing for us as an entire industry to do, like prioritize making things as cheap and as fast as possible, for the ability to win clients over from TradFi or just who are not currently in the financial markets. Like that to me is like really worthwhile. And then when you get to these scale numbers that we've seen with the growth of sort of the internetification of like all these different industries and the globalization, I think that you can take a materially smaller cut versus what TradFi did, and you can make a tremendous amount of revenue for the network. So if you go around the world, like there's all kinds of huge fees that people pay for silly things. If you wanted to buy equities in either India or China, you can do so through a BlackRock fund that charges you like 6.5%. So it's like 5% just initially, and then like 1.5% per year, just to get access to like the top stocks in those countries. That seems crazy to me. That's so expensive to do something that's so trivial. Like we know how to do this on blockchains without having to go through all these different intermediaries, add all this friction, and it's just a silly market. So I think that if you cut all that stuff out and you give access around the world, you can bring those fees down massively. So the token today is used for governance, for staking, and the staking I think is really important. So like that's like the most important thing to solve right now, is to make it so that the supply side is like just great. Like whenever you're building a marketplace, like you always need to build up the supply side first. Amazon, started with just books because they didn't want people to come there and see empty shelves, and then they expanded into other things. That's really what we've focused on for the Pyth network, is let's go get all the cryptos that people care about and some sampling of the rest of the world's data, and let's now continue to scale that. So like some of the improvements that are being made onto Pythnet will make it much faster and be able to have many more symbols, into the thousands in the pretty short term time horizon. And then we want to be able to like really kind of make it so that people can highly trust it. So doing those things to like aggregate together on chain, only from big institutions, that adds one element of trust. But then the staking model adds a complete second element of trust. Every single symbol, no matter if it's like a meme coin that only is trading on Radium, that's protected by staking. This is very novel. I know that other oracles have done staking, but if you look into the details, there's only for like one or two symbols. Every single symbol that get listed on Pyth is protected by staking that could get slashed in the event that the price is wrong. So, having this supply of secured price feeds is paramount. So that's what the token's currently used for. There's rewards, and there's inflation that's paid out to publishers for it, but there's something at risk. And then adding in some conversion so that like once there are meaningful revenues that the token that's incorporated, I think that'll certainly be like a fast follow as soon as we have those revenues.
Okay, cool. So for Pyth holders, it's a long-term game plan. You guys are basically trying to get to scale first and trying to focus on your unique selling points and get as many blockchains on board, and then later on, obviously, ways in which you can find ways to incorporate Pyth natively for potentially fees. Longer term plan.
Yeah.
Yeah.
And so we like to look at like sort of placeholders on what could the network potentially charge in terms of number of transactions. And that's one of the reasons why the volume transaction makes a lot of sense. People pay fees on that volume that's executed. So at 50 to 100 billion per month, they're already paying fees. So it's very reasonable to assume that, the Pyth fee could be some component of that. But again, I think that the right thing to do at this stage, when we're, in the kind of low double-digit millions of monthly active users in DeFi, is to focus on growth and try and just continue to push the boundaries on what's available. We're doing such big upgrades to, say, like the Pyth network today, that we think that there's so much more cost that we can strip out and speed that we can add, that I think that that's what you want to be prioritizing. You really want to be prioritizing global growth, and then when you get to the point where you've got hundreds of millions or billions of users that are like monthly active users, then I think that you don't have to worry so much about the fees.
So obviously now Pyth is very much focused on price feeds, especially as it comes to trading. But I'm curious now in terms of other use cases in Oracle, in a decentralized oracles. Obviously, is there other things you could use cases for? Like, I know that one thing that Chainlink does, for instance, is weather, right? Now I know, that's a completely different cup of data, but other things as well, like Chainlink is doing VRF, and expanding use cases beyond just that. So I'm curious if there's any other use cases you can see the Pythnet being used for beyond just market data, market prices.
Yeah, there are. Pyth has a random number. It's called entropy as well.
Okay.
And then Pyth does this other thing called the express relay, which is like order flow auctions that benefit the protocol where the opportunity is set. So there's these maximally extractable value kind of minor attacks that happen on mostly on the EVMs, where they basically bid out. In liquidations is probably the easiest one to articulate. So if a lending protocol is giving a liquidation reward for, say, 20% for someone to come and liquidate it, usually up to 95% of that reward is paid to the validators. And so the person who's going and liquidating actually only gets a really small amount. And then the protocol itself pays out the 20%, but it goes to these validators that really aren't participating. So this express relay was designed to make it so that there's this auction that's just between these searchers who are the valuable person that they are valuable role that the lending protocol is trying to entice to do something, and then the lending protocol itself. And it's becoming more generalized as like a back-end infrastructure. And so things like this, where Pyth has got a huge network of trading firms that are highly engaged and they're sending their prices to the network every day, where we can solve problems for big users of like the Pyth data. Those are the ones that we'll probably continue to add. From like a high level, how do I think about Pyth? It should be around financial market data, because I think that's, first off, number one, it's like many factors more valuable than generalized data around the world. So like weather data is generally subsidized by governments and usually available for free. So like you don't necessarily need any sort of specialization in the network side. You just need someone who's going to like kind of get 5 people to give you the same weather result. It's a very simple problem to solve. The other use case, though, that we're starting to see a tremendous amount of interest in is on AI. So everyone understands that the problem with AI is that they need access to real-time data. And what has happened with like the open internet is the Google business model effectively died or killed off a lot of the incentives for someone to leave their data set available, right? So like just to back up, if you have a website with some valuable proprietary data, you make it publicly available, so that Google can crawl it. You then basically will become part of their search results, but somebody's going to click through on Google and go to your website, and then you sell that traffic to advertisers at premium. With ChatGPT, that no longer happens. You no longer get the traffic on your website. They just take the most valuable part of your website and they show that as the results. Yeah. So as a consequence, many people who have valuable data said, all right, we're going to paywall everything. And actually Google's results are now much worse. So Pyth having this proprietary network of real-time data is very valuable in this world. So we've seen one of the best use cases, which is this protocol called OpenBB. They're off-chain, but they're basically trying to create a very high-valued competitor to Bloomberg using open source data, using a really powerful copilot. And so they have this insatiable appetite for Pyth data today. And we see lots and lots of examples. Like you can find Pyth data on Claude or on OpenAI or ChatGPT, and yeah,
that's fascinating. Yeah, I mean that's probably a big one. Decentralized AI. I think that's one thing that crypto can really give. Well, crypto networks in general are Web3, but also the data perspective as well, because this data is generally quite walled off. So just quickly moving, obviously we've alluded to it a few times now in this interview, and I'm not trying to, I don't want to set the Link Marines on you, because I know that
we're very good friends, the Link Marines and I.
Great, yeah, great, yeah, because I know it's, I'm sure you must probably also get tired of all the comparisons. So I don't want to dwell on it too much as well, because we've covered it, many people have talked about it, and obviously you've created Pyth Network for a reason. But if it was just one thing in terms of, like, you could say that one approach that you guys are taking that completely differentiates you from what Chainlink has built, what would that be if there's just one particular thing? Because I know there's many differences from a technical level, but just from a strategic level, what is the one thing you guys are doing that's different?
The nodes are the data owners. That's the biggest thing. So in the Chainlink network, the nodes are like DevOps teams that can do generic things and they can run jobs. And that's why Chainlink is able to, do some Oracle jobs, do some bridging jobs. They have this. It's almost like an Accenture or a McKinsey. Like you go to them and you say, "Hey, I want you to run these jobs for me," and they're like, "Great, we got 100 people, 100 nodes that can go do that for you." But it's not a product. It's not a singular product at all. It's not productized. You have to contact sales and you have to go run that for yourselves. In the Pyth network, we're building very specifically a product. It's the price of everything that's able to be provided everywhere. And the fact that the owners of the data are the nodes means that the network is able to scale into the hundreds of thousands, millions of symbols. We've created an entirely new economic model for data with a cost basis of zero. If you were to try and go and take a generalized node and say, "Hey, go get me equity data to put on chain," they have to go find a supplier. And when it comes to finding a supplier that's going to give you the most valuable data that they're selling to trading firms and earning $8 billion a year, it's going to be really difficult. The Pyth network was designed because the people who are buying that data are not very happy about buying the data. And it just so happens they have tremendous amounts of it. And so they have uniquely joined the Pyth network to go combat a different problem. It's that they don't like paying for this data. And as a result, Pyth network is born. And it was born with this kind of found data that can expand to any asset anywhere around the world. That's the biggest difference. And it hasn't yet been highlighted because the appetite for data on chain has been mostly in crypto. And I think that'll change since Trump's election. We've seen about 4 apps that have started making available like equity indices on various different blockchains. And I think that trend will continue to grow. It's what I talked about as like that global financial market. I think that everything eventually gets listed there, and Pyth is uniquely positioned to be able to provide that to the world.
Okay, that's fair. And coming back to this now, obviously now this is what I wanted to get to, and this is what we alluded to in the beginning of the interview. Trump's election right now and the opening up of US pro-crypto regulations potentially, and more favorable regulations for Web3 in general, right, as it relates to, and what your goal is of basically moving beyond just cryptocurrencies, right, onto to more market data for equity indices, for example. So I'm curious in terms of like, where do you think, or how do you reimagine the role of like oracles in 5 years from now? Where do you see, let's say 4 years time, right, the end of Trump's first term? like what sort of new markets do you think are going to open up? What sort of regulations do you think are going to come to the fore that could help, Pyth Network achieve your goal of like creating a broader market data for all types of prices?
Yeah, I think what we're going to see is the emergence of that emerging market to having access into investable products. And so I think it'll first start with like the biggest and most investable equities in the world, that are now trading as a synthetic version of it, or like a perpetual version of it, on chain. And I think it comes from the emerging world. So your Brazil, South Africa, Turkey, Nigeria. I think we'll start to see some diversification outside of just say Bitcoin, and in crypto markets, and they'll take a synthetic position in Nvidia. And I actually don't think you need to do a whole lot of tokenization in order for that to happen quickly. And the reason for it is that as long as you've got access to the fair price, you can create a perpetual market very easily. So let's say that your first step is you're in Nigeria and you wanted to give somebody access to trade like the Nvidia price that's currently trading on like the NBBO that I described in the US. As long as you have that price that's reflected, you could bootstrap like an LP position pool that people trade against. Now, what'll happen is all the flow will sort of be one way, and so the price will become like the demand will become kind of yeah exactly. So then what you do is you then evolve once you've got the volume to a position where you're creating this funding rate. And so you say, all right, we've got this pari-mutuel market which is trading now 20% over the global market rate, and we're going to start to do funding where like the longs are now penalized and the shorts are sort of incentivized. Any trader knows how to trade a basis. What they'll do is like, as long as you have the ability to trade US stocks, you say, all right, I'm going to buy up a whole bunch of Nvidia stocks in the US or in some access to a broker dealer, and then I'm just going to take this hedged short position and collect a 20% yield. That actually that acts as like a tether, almost like an issuer, where now those stocks are actually removed off the market. Now the trader is the one that's holding it, so he acts like the tether organization, where they've created that synthetic on the other side, and he has that offsetting exposure. But the markets are actually efficiently hedged together in that scenario, and you can do this bootstrap with pretty much anything around the world. Over time, what I think that evolves to is that when people start to issue, say, stock in the future, some component of it will be native digitally. And I think that the regulations will need to change so that there are more efficiencies around like the capital maintenance requirements for somebody that has these two positions. Because one of the clear problems with that is that you can't hedge them from a cash perspective. Like it looks like you have a really long position on the perps, or sorry, on the stocks, and a really short position on the perps, and they don't know about each other, so you can't net those off. So I think there's a lot of inefficiencies with it, but there's tremendous amount of efficiencies for this to be bootstrapped and to grow much quicker than people anticipate. We don't need to wait for the pilots of tokenization to really come to fruition. I think this can happen very quickly through this efficient market.
Okay, so just moving forward a little bit to next year, obviously there's a lot of excitement, as mentioned, regarding potentially changing regulations and just a more pro-crypto atmosphere. And this is more, so we can speak more broadly now about the broader crypto market. I guess you're curious. I mean, I think you were quoted in the blog as saying that you think Bitcoin could go to 100K by Q1 2025. Has that come forward a bit now, or is that still...
Yeah.
I mean,
I thought it was going to be last Friday.
Very close. Yeah, we came very close. Yes, I'm just curious in terms of like, obviously your background in finance, you're obviously native into crypto for quite some time. So I'm just curious in terms of your perspective of what's going to happen in the next few months. Very exciting time in crypto space for builders as well, because it's like obviously creating a pro crypto atmosphere will mean builders will want to go to the US. Maybe you guys will move back to the US.
And I love Portugal. I'm never leaving.
Never leaving. Okay, yeah. But I'm just curious, what's your perspective in terms of your outlook for the next few months or year even?
Yeah, I'm super bullish on the ability to onboard lots of people. Look, the three things that I think are the three components of finance, because I only really care about like the killer use case being global financial markets. There's going to be a lot of other stuff. The like DeSci could be a thing, or like DPIN. I think all that stuff's really cool. But the thing that gets me out of bed is creating this global financial markets. And so the three components: there's the price, there's like the exchange, and then there's the settlement. Each one of them needs to continue to improve. So price is, we've got 600 symbols. We need to be in the thousands. By the end of this year, that'll doubled. My hope is that it's going to be by many. It's going to multiply quite a bit next year, and we're doing all the work to be able to enable that. On the execution side, it's still not the best UX, right? Like there's companies like Infinex who are creating a centralized like experience into DeFi, and I'm starting to see more and more potential for stuff like that, where people really need to be walked into an environment. Like they want that that person to hold their hand, like the AOLs like did in the early days of the internet, where they can say, all right, you're safe here. It's fine to operate. And then on the settlement side, we just need much more bandwidth, and I think we need to be a little bit faster. And that's some of the stuff that like FireDancer was commissioned to build for Solana. They demoed a 1 million transactions per second version in production at Breakpoint. That's huge, right? Like we're looking at 2,000 transactions per second today in mainnet. So those types of leaps are tremendous. And so I think we're going to start to get a lot of breakthroughs. And then I think what we get next is more innovation on the execution layer. So when I'm pretty sure we have the majority of the primitives all figured out. Like people want to trade, people want to lend, but the features of it, just like the features in social media, are going to be like the killer apps. So Twitter had a certain set of features, Snapchat had others, and they all created these huge followings at the right time. I think that's going to be where we're going to see the most creativity. Where, say, like, if I take one point of finance that I think is probably the most broken today, it's the asset management side. If you wanted to be a limited partner in like an LP position into Sequoia, who's like one of the most successful VC firms in the world, it's impossible for you or I to do it. Like you have to be in this network for years. And that's sort of how everything works within finance. Like, anything you really, really wanted is not reserved for kind of your average retail person. So to me, that's the most ripe to be disrupted. It got very disrupted where you had both citizen journalism as well as like self-producing. It's like the Mr. Beastification of asset management. I think that we're going to get a Mr. Beast style asset manager that has trillions of dollars that is being managed, and that person can articulate very well a strategy that covers brand new meme coins as well as kind of the traditional markets and yield curves around the world, and it's going to have open access to lots and lots of people. I think we'll start to see those primitives really get explored over the next year, and then just continue to grow. And each iteration cycle, I think we'll be able to onboard many more millions of people into the system.
Yeah, I agree. That will obviously, one of them is specifically from the regulation perspective. If the SEC, the whole accredited investor framework is part of also the reason why these LPs, very restrictive LPs, right? And if we could have pro-crypto regulations which allow for people to actually invest irrespective of their capital balances or their income in these kind of larger primitives, would be great.
I think that crypto is such a, especially in the US, is such a revolt against a lot of the regulations that have happened to the equity markets in the last few years.
Yeah.
So like back in the early 2000s, there's a thing called Sarbanes-Oxley that was designed to protect people from like fraudulent accounting. Enron was like the big thing, but it just made it so that it was so hard to create a public company because the burden of filing was so high. Nobody went public anymore. And so you had these behemoths all grown. Like the unicorn was a really rare thing, which was that's why they called it a unicorn. But then you had like SoftBank and all these other VC firms pumping up these valuations where it was like as big as the stock market. And if you look at these numbers, like the number of IPOs in the late 90s were like 400 per year. Now it's like around 100. And you used to get like IPO prices at like $40 million market cap. Right now, the average is $6 billion. And these accredited investor rules, like they're not able to get access to any of this stuff, as you described. Like it's even worse. The whole system's rigged against them. So I think that the interest in crypto markets shows how fed up people are with the rules that are designed to allegedly protect them, but really just trap them out and make it so that the rich only get the opportunities that everyone wants.
Yeah, I would even be controversial to say that a lot of the very high valuation crypto projects that have come and hit the market and not been too receptive to it is because they've been inflated too much in the private market, and then when they hit the TGE, the retail is not really interested in being seen as exit equity. But that's that's a much bigger discussion, which I don't know if we don't have time to get into today. But yeah, we run to the end of this, Mike. So just want to quickly see if there's anything else you wanted to share about what's coming up in the Pyth Network, maybe in terms of your roadmaps, anything else you guys are working on, specifically in terms of launches or releases in the next few months that you think our community should know about.
Yeah, I think that the primary things that the network is focused on is the breadth of symbols and the speed with which the data is available. And like when you think about the network's growth, it should be you're rooting on DeFi in general. Like Pyth should be one of the main inhibitors if it doesn't grow, or enablers if it does, of the entire growth of the global financial market. And we just need to continuously make it faster and have more symbols. So, that's what you should be thinking about and, hopefully cheering on. And if we're delivering on it, then, I think DeFi has a very promising future. There's other stuff that Pyth will do that I described earlier around things like the Express Relay. But ultimately, I think that the things that'll be the most beneficial for the whole crypto ecosystem will be around those the symbol growth and expansion.
Got it. There's one final question. So, and I've been trying to think about this as well. So you got the Chainlink Link Marines, right? So you got the XRP army. You guys call yourself the Pythians, is that it?
Yeah.
Don't you think it needs to have like a combat kind of equivalent?
That's a good suggestion. I hadn't considered it.
You can speak the community, the brand, the community managers. Maybe think about like run a competition or something. To think of a new, to rebrand the Pythians, maybe to be a bit more like cutting edge, to go to battle with the other Oracle.
What's kind of crazy is if you go in the Pyth like Discord, which has got about 100,000 people, there's the Pyth Dojo, and the Pythians are jacked. Like they work out a lot. I don't have the impression in my mind that that some of the other people that you mentioned focus on physical health as well. But I would tell you that the Pythian community is certainly in really good shape.
I'm sure if it's like the emblematic of the Solana community, which seems to also be kind of like the Jack stereotype, which is great. I guess it's just like a matter of I'm sure Pythians is okay. It's guys.
I'll consider it.
Yeah, just worth mentioning. But yeah, Mike, thanks a lot for this conversation. It's really fascinating. I mean, obviously, oracles are such an important piece of crypto infrastructure, and I think that the goal obviously is beyond just cryptocurrency right now, and it's great to see you guys are working towards that. And hopefully, if we see this flourishing of the pro crypto regulations, it could help accelerate that and bring forward like permissionless prices to and solving for truth at T0. That's another one I've heard you mention before, and I really like that. So get into the closest correct price in a decentralized way right there at the moment it's printed. So yeah, I'm glad to see you guys are working towards that mission.
Thanks so much, Nick. We love the work you're doing, spreading the gospel. I think you guys are excellent. And thanks so much for having me on. This is a great conversation. I really enjoyed it.
Thanks, man. Cheers.
Yeah.